Good morning, guys. So I guess we'll get started. Have about 200 in here, so we'll get started. We have a lot to cover today. Thank you, everybody, for joining us. It's been a while since we've had a discussion on PPP stuff, and I thought a good start for everything was going to be a refresher, really, on a lot of items. If you think about it, there was such a rush to get into the loans, to get the money. We knew there were finite resources and a finite time frame, and a desperate need for relief at the immediate point in time when the loans first came out. And then it became clear 8 weeks wasn't going to be enough for a lot of borrowers, so they expanded it to 24 weeks, and 24 weeks is roughly half a year. So once we got that expansion, we got a lot of time, and our other business and life struggles and challenges came up. And as a result, I feel like a lot of what we knew from the PPP stuff, we had our knowledge fall off the table a little bit. I was starting to get ready for our forgiveness push, and I found myself trying to remember things that I'm sure I knew once upon a time. And as the supposed expert, to me, if I wasn't remembering everything, I could only imagine what borrowers were feeling. So I really thought kind of going over everything from the beginning, refreshing our knowledge was a great place to start on this forgiveness. So that being said, as always, I believe Kelly has emailed out a copy of the presentation to everybody, and a copy is available on our website at CeriniAssociates.com. Our presentation is current as of October 21st, 2020. No major changes have occurred since this time last week. We are providing information based on our interpretation of this after reviewing the law, the SBA IFRs. The webinar here is for educational purposes only and cannot be used to contest any IRS, SBA, or other penalties. We will make time to answer questions at the end of the seminar. Please use the Q&A feature. Additionally, Ken Cerini and Matt Burke from Cerini and Associates will also be answering questions as they pop up in the Q&A, just to try to help move things along. So please do not use the chat to ask questions. Please use the Q&A function. We thank you very much for your attendance. So as I said, we're going over a PPP refresher. Just about me, a little shameless self-promotion for those who are new to our seminars. I'm a tax director at Cerini and Associates. PPP stuff is my night job. Tax is more my day job. I have over 10 years experience. My industries include healthcare, financial services, technology, professional services, and I have some specialized knowledge in state and local tax and international tax. My contact information is below. Always love to get emails from people. It makes me feel special. So as I was kind of hinting at the beginning, I think a lot of us have a level of PPP fatigue. We're tired of thinking about it. We're tired of hearing about it. We're tired of having it on our balance sheet, having the worry, am I getting full forgiveness? Just like we're getting COVID fatigue, we're getting PPP fatigue. And I thought it would be great to go over everything again, kind of from the bottom up. So there's going to be, not a lot of new stuff here, but maybe some stuff that we just weren't thinking about or forgotten about. And during the past couple of days, what I thought was really interesting, I've been trying to follow the news on this PPP stuff pretty heavily throughout. And one area that popped up that I thought was really interesting was a report I saw earlier this week that, number one, the SBA is planning to release a borrower documentation guide. They're planning to release some lender forgiveness criteria. And there was a presentation to lenders in which the quote that I took away from it was, this is I'm hearing secondhand, but from a reliable source, someone who's been on top of these things, that the SBA is not looking to play gotcha on these loans, right? And I think it's a point I'm going to harp on throughout my presentation is the one thing we don't want to lose sight of. The banks don't want to keep these loans on their books, and the SBA and the government want to forgive these loans. So overall, don't forget that their real goal here is to forgive these loans. So always use that as kind of your North Star to guide your decisions as you're moving forward. So, with that being said, we keep getting a lot of questions about the forgiveness process and a lot of anxiety throughout the forgiveness process. And what I'm really hoping we can take away from this is borrowers now have a better understanding of everything and just trying to share our knowledge. So to that end, let's start kind of re-going over what expenses are PPP eligible expenses. So the main categories break into four. You have your payroll costs, your mortgage interest, but not principal, on real and personal property, rent or lease payments for real or personal property, and utilities for service that include gas, water, electric, transportation, which finally has a definition that we will go over, telephone, and internet access. So unless you are within those categories, it is not a PPP eligible expense. So keep that in mind, because I've heard some rumors. Someone was saying, oh, you can use it to buy PPE for the office. Oh, you can use it to renovate your office to make it more COVID friendly. No, PPP funds should and can only be used as forgivable costs in these four categories. Now, when we talk about payroll costs, that's what they really want to see. That's what the overarching goal of the program was: keep people on payroll, right? So that's going to be the biggest cost we're going to see. That's going to be where we're going to spend a lot of our time. It's really what we're going to be going over. And I think one point I want to hit on right away: your loan was based on 10 weeks of payroll, right? 2.5 months, effectively 10 weeks. You had 24 weeks to use it. So I think for a lot of borrowers, they're going to reach their full forgiveness with their payroll costs. And once you get to full forgiveness, just stop banging your head against the wall. Stop concerning with some of the little nuances of maybe, does this count, but does that not count? Once you get to that forgiveness amount and you know you have the forgiveness, great, you're golden. Let's not worry about all those little nuances. My mom used to always say to me, when you stop banging your head against the wall, it'll stop hurting, when I was, beating myself up over things. And I feel like that was great advice that, I say it a lot, but I really take it to heart when it comes to this particular program. So now, going over the payroll costs themselves. So your payroll costs have four categories that you can do: cash compensation, health insurance, retirement contribution, and state and local taxes assessed on pay. Of those four categories, there's 5 general breakouts for different people. You have your employees, your owner employees of a C corporation, your owner employees of an S corporation, your general partners, which are also going to include LLC partners, and your self-employed Schedule C. So those are the 5 typical categories of borrower. So you're going to have to fit yourself into one of those 5 categories. So for every nonprofit that is currently on here, you're not going to have anybody in the owner employee or LLC or Schedule C. Everybody's an employee of a nonprofit. So that makes your understanding a little simpler. If you're a C and S or an LLC, you're going to have a little more work to do when it comes to all of that. So let's start with cash compensation. Everybody has either an 8-week covered period or a 24-week covered period. I don't envision any scenario that I can see offhand, and I'm sure somebody somewhere has one that I haven't thought of, where I would go for an 8-week covered period. I just see no benefit. Everybody's going to be looking for you to do a 24-week covered period. Everybody's expecting you're doing a 24-week covered period. So to me, that is going to be where I'm really going to be focusing my presentation on. So when you look at employees, your cash compensation limit over that 24-week period is $46,154, which is a prorated $100,000 limit over the 24 weeks. Cash compensation includes any and all forms of cash compensation: salary, wages, tips, bonuses, commissions, hazard pay. If you paid it to an employee during your covered period, and or you incurred during your covered period and paid after, we'll cover that area next, it counts. So there was a question of, do these things or those things count? If it's paid to the employee, it counts towards that number. for your owner employees of C and S corporations, the SBA has said that your limit is different. Your limit is limited to $20,833, which is the 2.5 week number that they gave. Basically, they're trying to prevent quote unquote abuses of these funds, and this was one of the guardrails that they were putting in. So you're limited to that 2833 number or a lesser amount of your 2019 compensation. So if you were not on payroll as a C or S corporation in 2019, you're going to be limited to 0 even if you paid yourself now. If you had a limited amount of payroll, you're still going to be limited to that limited amount prorated over that period as well. So keep that in mind, that the owner employees of C and S corporations have a different lower limit. For LLC partners and general partners, they have the same 2833 limit, and it's going to be 92.35% of box 14A of their 2019 K1 is the base. You also have to back out section 179 and a couple other items that are listed on there, but the real meat and potatoes of this is 92.35% of box 14A. For LLC partners, you also must pay the funds either via distribution or a guaranteed payment during the period that has been set in the SBA regulations, which is in contrast to the Schedule C, still limited to the same amount, and it's limited to line 31, but there's no requirement to pay it. Now, just because there's no requirement to pay it doesn't mean I wouldn't show the money flowing from my Schedule C account, my separate business bank account, to my personal account. You don't necessarily need to, but why make your life harder than you have to, especially if some bankers are going to be saying, oh, you didn't pay it to yourself, we're not going to forgive it. A point on owners that have multiple businesses, and I had one of my clients bring up this question and idea pretty early on in the process, and I said it's a very good point, and I'd have to agree. Your owner comp is limited to that 2833 across all businesses which you have an ownership stake. So if I have 3 S corporations that all paid me an owner salary, I'm limited to 2833 on any one of those individual S corporations and in total. So I can't take 2833 on one, 2833 on the other, 2833 on the other. It's 2833 across all. I can choose where I want that to be. So you do have a little bit of flexibility there. So that covers the cash compensation. The health insurance, retirement contribution, and state and local taxes are exclusive of that 100,000 per year limit, meaning that they are above and beyond that limit. There's no statutory limits on these amounts. They just must be paid or incurred during the covered period. When you're looking at health insurance, it's going to include health, dental, and vision. I know one of our recurring questions we had gotten was the dental and vision count. On our initial calculations, we had always said to include them. The SBA has confirmed this on FAQ question 51. This is good for employees and owner employees. For owner employees of an S corporation, your health insurance should already technically be included in your cash compensation figure on your W-2, so you don't get to include that on as a separate calculation. They're not trying to punish you per se, but rather saying that, hey, under tax law, if the S Corp pays health insurance, it's supposed to be included in box 1 of your W-2 and part of compensation. You can't be double dipping, and we're limiting you to that. For LLC partners, that amount is already excluded out of your box 14A. Typically, it's treated as a guaranteed payment, which increases your box 14A, and then you take a deduction on the face of the return. So that number is already included in there. For self-employed Schedule C, same concept. You don't take that deduction when calculating your Schedule C income. You take it on the front page of the return. So it's already been included in there. And as I said, the payments do not count towards the 2833 limit. So now on to retirement contributions. Retirement contributions must be paid or incurred during your covered period and not accelerated from other periods. So when we say not accelerated, they're saying it shouldn't be a payment of future retirement contributions, and there's a potential it shouldn't be for past retirement contributions. the general gist that we're getting is that they're looking for this to be a 401k, 403b match that you pay during the period. That, I think, is what their intent is. And I'm going to cover prior retirement contributions when I kind of talk about future payments, just to kind of show you where my mind is going with that. But again, they must be paid or incurred and not accelerated in other periods for owner employees and employees. For LLC partners and Schedule Cs, again, they're already included in the calculation of box 14A, meaning they don't get taken off of your self-employment number. Ergo, you don't get to count them. It's already been counted. For state and local taxes, on our New York borrowers, who I think comprise the majority of our current attendees, it's going to be your state unemployment insurance and any metropolitan commuter transit tax. And that's going to be for employees and owner employees. For general partners and Schedule C employees, again, it's already included in that calculation. For the nonprofits, I know one of the questions has been, hey, we self-fund our unemployment insurance. Does that count? We have not yet gotten clarity on it. My general thinking is if you need it, I can see a place where a claim for that can be possible. It doesn't mean, as I was saying earlier, if I don't need it, I would go out of my way to include it. If I'm already going to get my forgiveness with cash compensation, which I think a good majority of borrowers will just hit their cash compensation number and be done with it. But if you need to start going a little further down, I don't know if I would necessarily challenge it, but if they want to include it, after doing some research and looking at the underlying federal law, I have an argument that it could be included if we absolutely needed to, but it hasn't been explicitly stated. So, caveat emptor there. Okay, so now that covers your payroll costs, and that's going to be the bulk of borrower costs. Let's talk about non-payroll costs here. So you have your interest on mortgage payments on real property, meaning buildings or land. Personal property, meaning business autos, explicitly stated was a business auto or equipment. To qualify as a mortgage, it must be secured by the property. And as I said, auto loans are specifically stated in the forgiveness FAQ. So I think they're looking to get to those right there. That's where we're seeing these right now. Again, it's interest on these, not the principal. So probably for the majority of borrowers, not going to be a particularly large component. When we talk about rent paid to an unrelated party is a forgivable use. There are no statutory limits. Rent paid to a related party, so let's say you have a building owned by a separate LLC, owned by the owners, or some other related party, is allowable, but limited to the mortgage interest. So you're kind of going to pass the mortgage interest through to the PPP borrower itself. So if you don't have any mortgage interest on a building that you own, unfortunately, that is going to leave you without any rent expense. It can be a lease payment for personal property, servers, copiers, and an interesting one that I think you have an argument on is software. So under the tax code, as I say, tax is my bread and butter, particularly in New York and the federal tax code itself, software is considered tangible personal property. New York makes you charge sales tax on it, whether you get it on a disc or you have it as software as a service. So that to me is a lease for personal property. Again, don't know if I would go tempting fate if I didn't need it, but I can make a reasonable good faith argument that that's personal property based on other defined areas of personal property. So now utilities, electricity, gas, water, I think those are pretty self-explanatory. Telephone and internet, again, pretty self-explanatory. Transportation. So one of the older IFRs was talking about it being transportation costs on like a business vehicle. The newest FAQ says it is for the state and local transportation utility fees and gave you a link as to what that is. The general sense you have here, if you know what that is, you have it. If you don't know what it is, you haven't paid it in the past and you're not paying it now. So it's very, very niche. If you know it without having to look it up, you're going to be able to take it. If you have to look it up, it's just not going to be something you paid. Okay, so now let's talk about timing here. The standard, and it has been written so many different ways, but the way things are shaping up, the standard is paid or incurred. So expenses for both payroll costs and non-payroll that are incurred prior to the covered period. So your payroll's coming into your covered period, or your expenses coming into your covered period, paid during the covered period are explicitly eligible. So anything that you incurred prior that you paid during is going to be okay. So that means any retirement benefits that you accrued and incurred in a prior period that you paid during your covered period may be eligible. And I use the word may there. However, FAQ 7 states they may not accelerate from periods outside the covered period. So I can see an argument again for those that were paid during that period, but I would not tempt my fate unless I absolutely had to on that. For payroll costs that are incurred during your covered period, or the alternative covered period. Now, I'm not going to spend a lot of time going over the alternative covered. As a matter of fact, this is my only mention of it in here. With 24 weeks, I don't think many borrowers are going to need to spend the time confusing themselves with the alternative covered period. Just remember, it's a concept that if you pay bi-weekly or weekly, you can shift your payroll covered period to match your payroll date. If you pay any other frequency, you cannot. But with 24 weeks, I don't know how relevant that's going to be for a lot of borrowers. But anyway, any payroll costs incurred during the covered period and paid by the next regular payroll date are eligible. So that means a payroll that I have as my covered period ends and I pay it my next regular payroll date is eligible. Now, the further out your lag gets, it hasn't been addressed, but our interpretation is it's whatever that first payroll after the covered period is that has any time in the covered period. So even if you have like a 2 or 4 week lag and you're still paying payroll of your covered period even after that first regular payroll, unfortunately, you won't be able to take that. The counterpoint to that is all of those payrolls that you paid coming in do count. So it's not like they're trying to punish you one way or the other. Now, because of that particular circumstance, any retirement benefits, which are a payroll cost, that are not paid during your covered period or by the next regular payroll date will not be eligible. And what I'm trying to highlight there is my interpretation is that any retirement matches that I would accrue and normally pay either after my fiscal year end or after my calendar year end are not going to count because they were not paid by the next regular payroll date. So you need to keep that in mind. And on any payrolls that go past your covered period that you pay after, you may need to prorate. Do it on a simple days allocation. Don't make it more difficult than it needs to be. Non-payroll costs that are incurred during the covered period and paid by the next billing date are also eligible for forgiveness. So again, you can take your costs coming in and any payroll costs that you had during your covered period, prorated accordingly, paid by the next regular billing date, also eligible. So now let's just go over some best practices and tips, some tricks that we've learned throughout our time thinking about this and different discussions that we've had internally and externally. I mentioned it right at the beginning. Borrowers were given 10 weeks worth of payroll and now 24 weeks to use it. So you're going to be able to use most of your loan proceeds on payroll costs alone. Once you get to that forgiveness number, it may be a good idea to give yourself a little bit of a cushion, but I don't think you necessarily need to. Stop, you're done. You've hit your forgiveness. Again, the banks want to forgive these things. The SBA wants to forgive these things. Show you used it on payroll. If your cash compensation gets you there, you're home. You're home free. Now it's just going through the remaining paperwork that you need to get done. I mentioned this, given that 24-week period and the above, you can probably skip that alternative covered period versus covered period decision. You just may not need to do it. The forgiveness standards on an overall are closer to a quote unquote cash basis than an accrual basis. There's a heavy emphasis on paid throughout the FAQs. So just keep that in mind. Doesn't mean that accrual stuff doesn't exist, but the emphasis is going to be on paid. The conservative approach will never steer you wrong when it comes to this. If you feel like a cost should be, if you feel like a cost should not be included, don't include it. Use your best judgments here. I go back to, I went to an IRS seminar about this time last year over one of the new IRS regulations, and this was the 199A, and the technical specialist in charge of the department was speaking, and she had a great quote that, we're all in this together, we're all learning this new stuff together, and I always think back to that right now, but I can very much see that the SBA and banks are going to have a very similar approach to this. We're all in it together, it's all new to us together. Use your best judgment, use common sense. And like I said, don't bang your head against the wall if you don't need to. Once you get to that forgiveness, once you're done, you're done. You're forgiven. Your loan is done. Okay, so now, once my mouse works, we're gonna hop over to our forgiveness applications and calculations. So we went over what we can use it for. Now let's talk about forgiveness applications and process. Just so people are aware, one of the items that I'm not going to be touching on during this presentation is going to be the salary reduction calculation. It's a very convoluted calculation. It's mechanical. I can probably spend a full hour going over that alone. And I feel like based on my conversations and my experience to date, it's not going to impact a particular number of borrowers. And I didn't want to lose people and have my eye glaze over when I look at it. And I can only imagine what a non-accountant thinks when they look at it. So I decided that skipping that for this presentation was best for us, so we can focus on some of the more meat and potato, I think, real impactful things for borrowers. So that being said, on your forgiveness applications, you have 3 separate forms. You have SBA Form 3508, you have 3508EZ, and the new 3508S. Most borrowers are probably going to end up using the 3508. Everybody can technically use a 3508. Even if you could use an EZ or an S, you can still file a 3508. Since I'm going to be focusing, since most borrowers are going to be using this, I'm going to be focusing my presentation on how the 3508 looks. The presentation I have is based on this form. Note that some banks are probably going to have their own portal that's going to probably ask you to type in the same exact information. In the end, you're allowed to use a substantially similar form, and I imagine now that banks have had some time to get their systems together, most of them are going to have their own way of going about this, but it's all substantially based on the same thing. The 3508EZ can be used by borrowers if they can certify one of the following. They are self-employed with no employees, which technically speaking has been superseded by the 3508S. The borrower did not have any wage reductions and did not reduce the number of FTEs, and the borrower did not have any wage reductions and was unable to operate at the same level of business activity. That's a newer safe harbor that came out as part of the PPP FA, and I don't think we appreciated it at the time it came out, but now that we've seen it on the application, it clicked. Finally, you have the 3508S, which is for loans of less than $50,000. Under the 3508S, you are exempt from FTE or salary reductions. The borrower should still have a copy of their calculations, but you're not required to show. I thought I just heard someone here, sorry. So again, if you can use the 3508S or EZ, there's no reason not to. Go for it. Just, I think a lot of people are going to end up with the 3508 normal, and that's why I'm going to focus on all of those, but use whichever form is most appropriate for you as a borrower. The forgiveness calculation, when you look at it on the first page, it's not overly difficult, right? And then you realize the layers and layers that are going into it. I've spent about two and a half hours yesterday, probably going to spend a little more time later on this afternoon today, building our internal calculator for this, what we're going to use to help anyone that we're assisting with their forgiveness calculations. The problem I'm running into is there's a lot of variables and a lot of different ways that I think people are going to end up doing this. So not 100% sure, how it's going to work, but I think we're going to, build it and then we'll see how it works and we'll be making adjustments. So your loan forgiveness comes down to the lowest of three numbers: your modified total, your loan amount, or your payroll cost requirement, which is 60% of your loan, right? It's the lowest of those three numbers. I would say in the neighborhood of 90% of borrowers, line 9 is going to be the one that is going to be the one that you need to have there. And that's going to be your lowest amount and the amount you're going to get forgiven, which is the amount of your total loan. I think that's where you're going to see it most. So if you look on the left side of the screen, I have our presentation. On the right side is what the SBA form itself works through. So now to get to this modified total, you have to sum up your payroll costs, which are going to be calculated on a separate SBA schedule. For your business mortgage interest, your rent or lease, not less, payments, and your business utility payments, those are direct numbers that you are putting in there. There's no SBA subschedule for those. That's your total sum of your payroll and non-payroll costs. You then would take away any adjustments for the wage reduction. As I said, that wage reduction calculation is a little convoluted. I don't think it's the best use of our time to go over it right now. That's your subtotal. You then take away that FTE reduction quotient. We will spend time going over the FTE stuff to come to your modified total. So if you look right here, if your loan is for $500,000 and you have $800,000 of payroll costs during your covered period, no wage reductions, and maybe a 90% FTE quotient, your payroll costs still exceed your PPP loan amount, and you're done. That's it. You've gotten there. You have to even think about my mortgage payments, my rent, or my utility payments. I've gotten my forgiveness. So that's what I keep trying to, get at when it comes to that for borrowers. But you look at this and you say, wow, not that bad of a calculation. It all kind of makes sense. And then you realize, oh, there's a subschedule, and subschedules are the subschedule. And all of a sudden you feel like you're looking at your tax return again. So on the surface, you think, oh, what you're trying to do is not that bad. When I have difficulty thinking about something, or when I'm struggling, one of the tips that one of my earliest mentors taught me was break everything down into the smallest possible pieces that you can. Start your understanding from there and build your way up. So if you're having trouble, just find the part that you can understand or easily understand, or the smallest piece, and get your understanding there, and then build like a house off of your foundation, and eventually you're going to get there. So now the forgiveness calculation that has to be submitted to the SBA includes the page 1, which we just had on the prior slide, which is that first page with the basic calculation, and Schedule A, which is page 2. It's required to come with this forgiveness calculation, right? So from there, on Schedule A, you kind of have 4 sections that we need to go over here. You have PPP Schedule A, Worksheet 1, which is your employees that made less than $100,000 in 2019. You have PPP Schedule A, Worksheet 2, aka employees that made more than $100,000 in 2019, and that's going to be the next smallest part that we're going to go over next. You have your non-payroll costs, which are your health insurance, retirement plan, and state and local taxes. So if you look on this, there's no subschedule. You just put in the amount that you paid for those amounts. Now, you have to include some documentation with you, and it doesn't mean that I wouldn't be prepared, if I'm a borrower, to have a per employee backup of all of these and make sure my ducks are in a row. But on this form, you just technically need to put in those amounts. You finally have a separate area for the owner compensation. Why is that there? Because the owner compensation has special limits note that because it's in a separate area, they don't count in your FTE calculation. So I know that, there's been some, we've done a couple in the office and we had to kind of redo it when we realized, oh, wait, the owner doesn't count in the FTE calculation. Doesn't count in your reference period, doesn't count your covered period. So it's not like it's going to take from both sides of the equation. That's how you get to your total payroll cost. These are 4 individual calculations, small bites off of each of these that you just need to work through. And take your time, do it right, and it will work out for you as a borrower, right? And as I highlighted, this is required with the forgiveness application. Now, after you do these 4 to get to your total payroll cost, you have 2 additional, you have an additional part of this form, I should say. They then ask you about your safe harbors, right? And there are 2 safe harbors that you can use to just give yourself a 1.0 reduction code, meaning that if you are in a safe harbor, you're deemed to have a 1.0 and ergo no FTE reductions. We will cover these safe harbors a little later because I think that they're important for a lot of borrowers. One is that you are unable to return to the same level of business activity, and the other is that you have effectively the same FTE as February 15th, 2020. On the surface of this form, they ask you to put in your FTE during your reference period. Again, the reference period will be January, February 2020 for a lot of borrowers. If it's not January, February 2020, it'll be February 15th, 2019 to June 30th, 2019. That's your average weekly FTE during those periods. I think for most borrowers, conceptually, it's easier to think about it as January, February 2020, but a second form does exist, and for some borrowers, that number could make sense to use a different reference period. Your average FTE is calculated on those Schedule A worksheets. So you'll have that there. It's going to be in your calculations in the 3rd and the 5th line down. You add those 2 up. You compare those 2. And that's what your FTE reduction quotient is. You basically divide them. Now, again, if you are in a safe harbor, you are able to just put a 1.0 and you're done. Now, it's a little more than just saying, oh, yeah, I'm in the safe harbor. You need to document it and think about it. But you put those in and then you are done. So that's how the Schedule A works. And like I said, this Schedule A needs to go to the bank for forgiveness. Now you have your Schedule A worksheet. Again, these worksheets are designed to help you fill these sections out. If you look at it all as one big thing, it's going to overwhelm you. But okay, I have my first part of my Schedule A. Let me go to my first part of my Schedule A worksheet. Let me go to my second part of my Schedule A, go to my second part of my Schedule A worksheet. So these are the Schedule A worksheets. Inside of here, you need to put the employee's name, the last 4 of their SSN, what their cash compensation is over the period. You're going to want to put the amount that you're asking for forgiveness for on this chart. So no one should ever exceed $46,154 if you're using the 24 weeks. And for any borrowers that have reimbursements that, I'm sure we have been discussing with you regarding the reimbursement. So if you'll know if you're a borrower that has a reimbursement by this point in time. If you don't know what it is, and it's more likely than not you don't have one, if you're not asking for forgiveness for those parts, then do not put anything that you're not asking for forgiveness in that calculation. You then put in the average FTE calculation and any salary reduction calculations in that first table. In that first table, you also put in your FTE exceptions. The easiest way to think about the FTE exceptions, which we will go over, is going to be, they're like phantom FTEs. You just add them back into the number. So I know a lot of people are kind of wondering how the exceptions are going to work. It's as if you just add them right back into that number. So now that's table 1. Table 2 is the same as table 1, except for the fact that hourly salary wage reduction doesn't matter because of the statute saying if you earned over 100,000, you could make the reduction. Just conceptually, most employees are not going to work for a 25% pay cut, particularly those that make less than 100,000. So that's why I just haven't seen a ton of people that have this problem in the wild. That's why I didn't want to spend too much time on it. Important point. This worksheet is not required to be submitted to the bank. That being said, I wouldn't be shocked if every bank thinks it needs to, and they're going to ask you for it. So you should be prepared for it. But under the regulations, you don't have to submit it. But knowing how the banks are treating this, I would be prepared that you need to have this already. Now, obviously, on the SBA worksheet, they give you about 8 employees. Most people have more than 8 employees. So you could just make your own in Excel or whatever format you wish to use and attach it accordingly. And you need to keep this on file. That's your Schedule A worksheet. And that gets you to fill in all the parts on Schedule A right here, Schedule A right here. You now have your health, your retirement, your SALT, the amount paid to owners. You have your total payroll costs, which then flows back up to my payroll costs. I put in my other costs, any wage reductions, which are going to come from my Schedule A right here. My FTE quotient, which is now going to come from my Schedule A right here. And now I have my modified total. I know my PPP loan amount. My payroll cost requirement is just taking my PPP loan and dividing by 0.6 to get to the, dividing my payroll cost divided by 0.6. And I picked the lowest of those 3 amounts. When you break it down like that, not as burdensome as maybe we thought. It's still pretty burdensome. I'm dreading doing these to a degree, but we'll get there. We'll get through it together. Okay, on to the FTE calculations. The SBA hasn't given a whole lot on the FTE calculations. A conservative is the recommended approach, is to calculate on a per week basis and be as conservative as you think you need to be when you're doing this. The SBA allows for 2 methods on your FTE calculation, what I call the exact and what's known as the simplified. The exact is based on, quote unquote, the average number of hours worked per week divided by 40. The FTE is based on a 40-hour week. I know some people have 35-hour weeks. Some people have 37.5-hour weeks. Some people have 43.6-hour weeks. We all have different number of hours in the week, but the FTEs are based on 40. Remember, you do your reference period and this the same way. So it's not as if having a lesser is going to be a problem because it works on both sides of your coin. A simplified method uses a 1.0 for employees that work more than 40 hours per week and 0.5 for employees that work less than 40 hours per week. So a very simple calculation here. The average hours per week for these 7 employees, I have one that averaged 42 hours per week. That's a 1.0 under exact, 1.0 under simplified. You cap at 1.0. For employee 2, I have 40 hours per week at a 1.0 and a 1.0. Employee 3, I must have skipped. Employee 4, 37.5. Under a exact, that's a 0.9 FTE. Under simplified, it's a 0.5. Employee 5 at a 20-hour is a half FTE on both counts. Employee 6 with 12 hours is 0.3 on exact, 0.5 on simplified. Employee 7 is 8 hours on the hours worked per week, 0.2 on the average weekly, 0.5 on the simplified. Again, conservative and recommended is do this on every week basis. I have seen some approaches that are just calculating on the full period approach, meaning that if I have someone that works 5 hours for me during the period, they're a half because they're only working part-time. That distorts the FTE reductions because if I have someone I fired during the period, that would count as a half. I think the application calls for the average weekly number of FTE, so we're recommending that you do this calculation on a per week basis. The way that I'm looking at it when I'm starting to do ours is I just look at how many I had as of that Friday for the weeks over the covered period, right? Don't let the nuance overwhelm the intent. They're looking for the average number of FTEs during your covered period. So don't, if you got your money on a Wednesday, oh, it's only 24 hours they work, oh, should I divide by 24? Don't get too crazy when it comes to that. Look at it for the week ending for the weeks in your covered period. Include any PTO or other hours an employee was otherwise scheduled to work but may not have, right? So, early on, when the first borrowers, our work call was pay people to do nothing, pay people to do nothing, pay people to do nothing. Well, that's how you're going to have to work through that particular calc. You have to calculate your FTEs a bunch of different times and a bunch of ways here. So you have to do it for your reference period, your covered period, and for your safe harbor calc. So as of February 15th, 2020, again, use the payroll week covering this date between February 15th, 2020 and April 26th, 2020, and as the date of the application or December 31st. Here's my best practice for this. Don't overthink it. Think about what the average number of FTEs is. Use your best judgments to make these calculations. They're not looking to play gotcha on this. I know other government applications, they have these strict defined rules, and we're also used to playing in that sandbox. Use your best judgment here. Don't overthink your problems here. Whatever you think is reasonable, because you as a borrower ultimately are asserting that this is an accurate calculation, use that, please. It'll make your life easier. Okay, so now the FTE Safe Harbors. There are two safe harbors that allow you as a borrower just to assume a 1.0 FTE reduction quotient. The business activity safe harbor is one that we really haven't touched on. And basically, what it says is that if you are unable to operate at the same level of activity as you were in February because you're following HHS, CDC, or OSHA requirements and or state and local government requirements because they are considered to be based on those standards, if you're not able to operate at the same level of February 15th through your covered period, hey, you're good. What you have to do is you have to document in good faith that you were unable to operate to that level between February 15th, 2020 and the end of the covered period at the same level of business activity because of your compliance with those regulations. The IFR on 622 interim final rule stated that it has both direct and indirect compliance. Further, they have stated compliance with state or local government shutdown orders will be considered as from these agencies as they're based on those. The only example they give us has to do with a beauty supply store that has both an online and a retail component. They had to close the retail component during the covered period. As a result, they are unable to return to the same level of business activity. That is all we have to work on off of this. I wish we had more. We just don't. So they say the documentation should include a copy of the applicable COVID requirements. So for New Yorkers, that'll be the executive orders and the phase 1 through 4 guidelines, and your relevant financial records. They're going to be applying what looks to be an empirical test on this, right? So if you have a significant decline in gross receipts and or a decline in gross receipts, and you think overall that you are in good faith having this as a result of this, you can avail yourself to this safe harbor. We don't know what percentage. It's not a bright line test saying if I have 8%, I have a decline. If I have 12%, it's facts and circumstances. Look at the overall holistic picture and say, am I able to be at the same level as I was as of February 15th, 2020? I would say for a lot of borrowers, the answer is probably going to be no, but look at it overall. Us as accountants, I haven't seen Matt Burke in person since February. He's been working remote the whole time. I've been in the office. We as a whole, though, still have the same level of business activity when I look at it holistically, even though we're doing a lower percentage of people in our office. We may not be able to travel to client sites. Not saying everything is perfect for us, but I look at the overall picture, and I'd say that we, because of our remote capabilities and our overall things, probably have not had an inability to return to the same level of business activity. Use judgment, use good faith. So, that safe harbor was not one we really talked about, but I think a lot of borrowers may be able to avail themselves to it. The other safe harbor is the one that's been around since the get-go, which is that rehiring safe harbor, that you had reductions between February 15th to April 26, 2020, and you restored to the amount of February 15th FTEs by December 31st or the date of the application. That's the other safe harbor that has been there. So basically, if you rehire the same FTEs you had as of February 15th, you should be in good shape for that safe harbor. Let's talk now about the FTE reduction exceptions. So these are reductions that don't account, these are staffing reductions that don't count against your FTE reductions, meaning that they don't want to penalize you for them. They act as an artificial increase to your FTE counts. You basically treat them as phantom FTEs. You can do this where you have any position in which a good faith written, note my emphasis on written, offer to rehire the individual who was an employee as of February 15th and the employee rejected the request and the employer was unable to hire a similarly qualified employee by December 31st, 2020. Now, I know if it's me, my question is, well, what does half that stuff mean? This is all we have to go with. So we're going to use our best judgment when we're showing, hey, we tried to hire somebody and we couldn't. Either there were no candidates available, maybe we did a couple interviews, show whatever efforts in good faith you made to try to hire somebody new. No, there's no bright line in the sand here that says do X, then Y. Use best judgment. Another exception, any position in which a good faith written offer to rehire, restore reductions, or otherwise return to full employment and the employee rejected. Now, part of that is you're supposed to notify the unemployment office. I am unfamiliar with how that notification is done. I haven't seen anything on it. And I also haven't looked too far in depth on that one, but you are supposed to do that as well. Finally, any employees who were fired for cause, voluntarily resigned, or voluntarily requested and received a reduction in hours. So that would be any non-Families First Coronavirus Relief, the Coronavirus Sick Leave, FMLA, FLSA, or maternity leave. Anybody that said, hey, I need to work less, and they asked for it, you're not going to get penalized for that either. So, maternity leave, sick leave, caring for people, saying, hey, I don't want to return to the office because I'm scared. It was a voluntary reduction. You're okay. Make sure you can document as voluntary, though. And blanket, these exceptions only apply if you don't fill the position otherwise. If you have an administrator that is out on maternity leave and you don't fill that position, okay, you can use that exception. You have an administrator who resigned, you don't fill it, great. If you fill the position, don't double count the FTEs. So now, I've seen, and I want to thank the client who I saw is on the presentation who provided this report to me. I did blank out all the information that was on there. She's probably laughing right now. But the major payroll processors, so for ADP and Paychex, and I'm sure the other ones as well, have created reports to assist with forgiveness. My warning here is don't automatically assume that these are correct. You need to review for errors. On this particular report, I can tell you that the employee right here is an owner-officer of an S corporation. The owner-officer of the S corporation is limited to $20,833. Well, they're showing the full amount of SBA payroll cost here. Might I add, they are not showing any amount for employer benefit costs, maybe because ADP is unaware of it. I wouldn't just take this off and go it on full faith. Review it. Make sure it is accurate. To me, this is going to be something as a tool that you can use. the ADP and payroll Paychex reports have been rife with errors since the start. Be prepared. And remember, you're the one that's representing this. Make sure it's your data. Here's what the Paychex one looks like. Again, very similar to all of this. They actually have more data here. They're actually giving you the FTE based on payroll hours. Doesn't necessarily mean that this calculation is 100% right. You as the employer, as the borrower, you're the one representing it's accurate. Don't just assume that what you get from Paychex is completely accurate. Is it accurate? Probably. In the regulations, they say that lenders can rely on reports from reputable third-party payroll processors as part of their forgiveness review. So overall, it could work out for you, but doesn't mean I would just blindly take this. So now let's go over some forgiveness best practices and tips here. You have 10 months from the end of your covered period. So for the earliest of earliest borrowers, that's going to be July 2021. July 17th, 2021, I believe is the exact date. There's no need to rush unless you have a reason to, meaning there is some other circumstance that maybe you need to think about that's unique to your scenario that you may want to get it in earlier than later. Each person should make their own decision, but don't let the bank bully you into saying you need to do it now, need to do it now. I've seen the emails, I've seen what they're sending out, I hear what people are saying. You have 10 months. You could wait for 9 months and 26 days before you do it. I wouldn't do that, and if you try to do that to me, I would be a little upset, but you can wait. There may not be a benefit to being an early adopter here. There was a benefit in applying early with limited funds, needed it right away. Here, the banks are going to be refining their process. The SBA or Congress may reduce the required calculation or documentation, right? Why be an early adopter if you don't absolutely need to be? We stand here today on October 29th. Banks have 60 days to make their decision, and the SBA has 90 days to provide the funding that gives the forgiveness. So you have a 150-day window. So even if you apply today, the probability that you are forgiven between now and December 31st, 2020 is not particularly high right now. Many borrowers can conceptually spend away their reductions. Kind of the example I gave about earlier. You could have a 92% FTE calculation, but because you just have so much payroll costs above and beyond that, that you're still going to be at the lowest of your three amounts and you don't have to worry about it. Never lose sight that the SBA and the banks want to forgive these things. Remember that overall. Use your best judgment. Don't get flustered. I know it's a lot of stuff. Don't overthink your problem. I think we're all getting into paralysis via analysis right now. Don't overthink your problems when it comes to this. Don't make it more complex than it needs to be. I think I actually have a fortune cookie somewhere on my desk that says that. I thought it was a great fortune. Okay, so now let's talk about the documentation and the process. Okay, the SBA application lists certain documentation that's required to be submitted and other that's required to be maintained. As I mentioned at the onset, there are now reports that the SBA will be reducing or releasing a checklist for all of this. So I would definitely wait until that comes out. Remember that what the SBA asks for and what your lender asks for may be different. I can see lenders asking for a lot more than what the SBA is going to ask for. For instance, wouldn't be surprised if the lender asks for your most recent filed tax return. That doesn't really have any bearing on any of this. All things being equal, the tax return has almost no bearing on this, but they may want this. My general thing is always an over-prepared borrower is going to be better than an under-prepared borrower. But there's also going to be a lot of work. It's a lot of human capital you're going to have to expend. It's stress. It's time out of your work day. It's time out of your employees' work days. Try to find the right balance accordingly. So per the 3508, this is what documentation is required. You have the forgiveness calculation form, which is that 11-line item. you have your Schedule A. For payroll, you need bank statements or third-party provider reports showing compensation to employees, tax forms or equivalents for payroll periods that overlap near Form 941 in state, and any receipts, canceled checks, and account statements for employer contributions to health insurance and retirement plans. So basically showing that you paid it. For your FTEs, you need to document your FTEs for the reference period, and they ask for payroll filings that cover that for the beginning of the covered period, right? They really ask for payroll filings. For your non-payroll stuff, for your business mortgages, they ask for the amortization schedule, proof of payment, or account statements showing that you had it in February 2020 and you have it going forward. Same thing for your rent and leases and for your business utilities. This is a lot of stuff. That's why I think they're going to send this new checklist out and they're going to streamline this process. I don't think, this is what I would get together now and what I would definitely have prepared if I'm a borrower, but don't be surprised if long-term this list gets reduced quite a little bit. Now, for documentation that you need to retain yourself, you have to have that Schedule A worksheet. When you are doing the documentation worksheet, you need to have documentation supporting the listing of each individual, including the reduction calculation. So that's going to be basically your payroll registers. You're going to want to have documentation for employee job offers, refusals, firings for cause, resignations, and the voluntary reductions. You're going to want to have your documentation that you were unable to return to the same business level activity. So this must include a copy of the requirements and your relevant borrower financial records. Again, do I know what financial records they're asking for? No, but I imagine gross receipts are probably going to be where the bread is buttered on this. So keep that in mind. We don't have an exact listing. We know you need a copy of what the requirement was that had you shut down and your relevant financial records and any documentation reporting, supporting the FTE Safe Harbor calculation. Per the SBA, all documentation, your application, your certification of necessity, your forgiveness application should be kept for 6 years after you're forgiven. It's a long time, 6 years, but that's what they say. Let's talk about the process here now. The lender review. The lenders have 60 days to review the application and issue a decision to the borrower. The lender must confirm receipt of the certifications, confirm receipt of the documentation. They must confirm the various calculations, meaning making sure your math is right pretty much, and confirm that you use at least 60% on payroll. What I'm getting at with this here is this process is largely self-certification. So the lenders are only really supposed to make sure that you didn't make a massive error and that you gave everything that needs to be given, but you're certifying that everything you gave is true, that you can do the FTE Safe Harbors, that the cash comp is there. You know, they're kind of there as the first line of defense, but I don't think they're going to be as hard-nosed as we think they may be. Now, I could very well eat those words, but based on what the IFRs say, that they only have to do a limited number of items here, right? They say in the IFRs, the borrower is ultimately who is responsible for the accuracy of the calculation, and all the lender has to do is a good faith in reasonable time review of the calculations and supporting documentation. An exact quote is they can do a minimal review of calculations based on a payroll report by a recognized third-party processor. I emphasize this here. Lenders may rely on borrower representation. Again, this is a self-certification, not dissimilar to income tax to a degree, right? You think about, particularly for business owners, you know, your filing of your taxes is a self-compliant, self-certification system, and then they come and audit you to keep you honest. Very, very similar system here, right? If you don't give enough information on your first go, lenders should work with you to correct any sufficient, meaning you get more than one bite at the apple when you send to the lender. The SBA wants the lenders to kind of be their, their grunt workers, collate, gather everything, make sure you have everything, make sure everything is square. That's what their real purpose is on, this process. So now you have the SBA review. The lender tells the SBA, hey, this is our forgiveness decision, right? The lender's the first line of defense. All the SBA is going to get is that forgiveness application and the Schedule A. They're not getting your payroll reports, your third-party payroll, summary, your health insurance documentation. All that stuff stays with the lender. It doesn't go to the SBA. In this process, the lender only must confirm that the information provided reflects the lender's record and it has made a decision in accordance with the SBA regulations. The SBA then has 90 days to submit, right? If the lender determines that the borrower is not eligible, they must let the borrower know, and you have the right to appeal to the SBA. I am knocking on wood that I never have to learn what that process means. I'm going to take a look at it and we'll be prepared for it. But like I said, they want to forgive these things. So I am hoping that long term, no one on this webinar is ever going to have to fight that fight. But if we're going to have to fight that fight, we'll be ready, we'll be prepared. So now the SBA review says if the SBA is reviewing the loan in depth, it will request the following from the lender: a copy of the application form, the loan forgiveness application and supporting documentation, the transcript of account, the PPP loan note, and other documentation from the SBA. And I believe that they say they also have to let the borrower know that that's going to happen. So now, I think the question that I think just probably popped up is the SBA still continues to threat or promise, depending on how you want to look at it, to audit loan forgiveness applications for all borrowers whose proceeds exceed $2 million, right? There have been no published guidelines or procedures on this yet, other than just great media sound bites of, no, if you got over 2 million, we're going to audit you and make sure you need to get it. They haven't said what that really means. Keep in mind, they have a 6-year statute. That's a long time. It's double an IRS statute. Very, very long times. This audit is very unlikely to occur in that 90-day window after the lender issues its forgiveness decision. So I've heard an interpretation that means, and I've seen it in an IFR, that 90-day window may not be relevant for borrowers over 2 million because the way it's written, the SBA may have the time to review prior to issuing of forgiveness. So that could mean that borrowers that are outside of over the 2 million could get it past that 90 days, further delaying all of this. We just don't know yet. We don't know enough about it. The IFR issued on June 1st, 2020 and revised in June 2020 indicates that the SBA review of loans will focus largely on the eligibility, necessity certification. So now, one other item that pops up is apparently the SBA is preparing to release some sort of necessity questionnaire for borrowers. That to me is going to be very interesting to see what comes out of that, because I can remember pretty distinctly, the CARES Act passed on March 27th, 2020. The loans first came out on April 3rd, 2020. The world felt a lot different back then. I want to say there was a lot more dread. There was uncertainty. There was concern. I think that we should all commend ourselves. We've done a great job adapting to the business and operational requirements of working remote, of working in this new world. There's still bumps in the road. There's still difficulties. But back then, we didn't know what was going on. We didn't know what was going to happen. Everybody was uncertain. I spent more time on my cell phone those couple of weeks than I have probably the prior 18 years I had it. My phone was getting mad at me. It was on so many phone calls. There was uncertainty. We all felt it, and we all had discussions on it. So I know that some people are a little worried about that question, but if you think back to what it was like back then, we were all worried. And I think it's a fair thing to say a lot of us thought we needed this, even if it turns out that, hey, we were able to adapt to the remote stuff pretty well. The loan amounts and the use of proceeds, and the SBA or the loan forgiveness amounts. one thing that they have said since the start: if they determined you are not an eligible borrower, there is going to be no forgiveness. And I think this begs the question: how are they going to do this in the 90-day window? They couldn't get the application out until an hour before it was supposed to go live. It's not exactly an organization known for its speedy and expedient responses to things. So, I'm really curious where this is going to go next and see how this process starts. All right, now for our tax considerations, which I think I accidentally deleted this slide. Okay, go me. So anyway, on the tax side, the IRS came out early on and said, hey, this is going to be a tax-exempt form of income, and as a tax-exempt form of income, any underlying expenses are therefore not deductible, which has the same mechanism as making these expenses income to the borrowers. I haven't said anything else since then. Now, I've heard a bunch of different approaches as this comes up. The first one is, I know some people who are saying the IRS has particularly erred on this interpretation. They are wrong, they're incorrect, it's not the proper application of law, and there are, for any of my tax nerds in here, and I might be the only one, thinking about it as cancellation of debt. And when you have cancellation of debt that's excluded from income under other pretenses, like if you're bankrupt or insolvent, you don't go back and change the past for those expenses, but you have tax-exempt income now. This is cancellation of debt income. Why should I have a change in my expenses as a result? I don't have it under other cancellation of debt. They're preparing to fight them on that. You have some schools of thought that the non-deductible expenses that exist will happen in the year of forgiveness. So if you don't get forgiveness in 2020, but you do in 2021, you're going to take the tax hit in 2021. You have some schools of thought that state, well, I didn't have any tax-exempt income in 2020, and I had tax-exempt income with no expense in 2021. Those are separate taxable years. Ergo, I have no non-deductible expenses because at the end of 2020, I didn't know if I was going to have forgiveness. I think it's an interesting approach. It's a little nuanced. I think it's begging for trouble. And then you have the people who are just crossing their fingers, maybe me included, that they are going to just get rid of that and say, no, it's definitely deductible. And I think that's a real distinct possibility. Obviously, right now, as we approach November 3rd, not a whole lot's going to change, but we'll see what happens from there. And then, there's some people who say, well, okay, I have the forgiveness. Do I now have to go back and amend my 2020 return for those non-deductible expenses? The short story is we just don't know enough yet to tell people this. When I'm doing my planning and projections right now for nearly all of my clients, I'm presenting them with two scenarios. One is their scenario without the PPP forgiveness. One is the scenario with the PPP forgiveness, as to have people prepared for how it's going to work. One of the reasons I'm encouraging people to wait until later on is so we have this tax clarity. And I think there is a little more merit than people give credence to, that the idea of I didn't have tax-exempt income in one year and I have tax-exempt income in a separate year doesn't change that prior year, because one of the key tenets of taxation is each year is an independent event. I've researched this in the past for something else, and how a future year can affect the prior year seems a little interesting. So patience, I think, right now on the tax side. And I know I got a couple email questions on this prior. I wish I had better answers to give people. I really do. And my deleted slide basically said this exact same thing. And anybody who's been in a meeting with me recently has heard this speech in the past, and nothing has changed. Things are going to have to change somewhere. I'm sure they will. And when it happens, it happens. And if not, we'll have to make our best decisions when those times come. But right now, I'm not at gunpoint for this. So I'm not going to force my hand when I'm not at gunpoint. All right. So here are my key takeaways right now. If you get nothing else out of my webinar today, number one, as a borrower, you have 10 months. There's no need to rush. Banks are still working out their systems, and that's okay. somehow doing an invite only. I know one of the participants today has been invited to the Bank of America. I have known another participant who's been invited to Chase. I saw that Bridgehampton National Bank opened up their portal yesterday. Banks are still kind of figuring their stuff out. In a matter of fact, in the Bridgehampton Bank, they even said if you have under 150, you may want to wait to apply because more things can change. So banks are still working their stuff out, and that's okay. You know, be on the lookout for it and be prepared, but know that you don't have to do anything just today. This program is largely self-certification, and the calculations are the borrower's responsibility. We're so used to the government being the police, and they still want to be the police when it comes to this program because it was their funds. But think of it kind of like the LIE to a degree. They're not going to pull you over for going 10 miles an hour. Maybe if you're going 30 miles an hour over, you get the ticket, right? That's kind of the analogy I've been thinking about when it comes to this, that they want to police it, but they're not going to pull you over for 1 or 2 miles an hour. They want to forgive these loans. Remember that. Think that always through. The current understanding is still, as of today, the expenses are non-deductible and borrowers should plan accordingly. So that being said, I just want to make 2 quick statements. Number one, starting probably sometime in November, this PPP stuff is my night job, so to speak. My day job is tax and business advisory. We are getting ready to start having a business webinar series where we're going to be interviewing different guests in the business community. I have a very specific target in mind for my first one. I think he's a great person who I have a great rapport with. My great marketing team, who I also want to say thank you to Kelly and Christina. They do such a great job putting all this stuff together and making sure that we can do this. And then, you know, I want to thank them for being great members of our team, have been pushing me to try to push this business seminar series along. And I kind of keep ignoring their emails because I have just so many other plates I'm trying to spin. But look out in the near future for that particular invite, because I think, you know, I have a lot of other great knowledge to spread, and we as a firm have a lot of other great knowledge to spread, and I think it's going to be a great platform for us to do it. So that being said, I want to thank Ken and Matt as well for answering a lot of the questions that were popping up during the Q&A. Try to see if there any that are still unanswered right now. I'm just going to start down here. What does it mean to calculate FTE on a weekly basis? How about if someone leaves midstream in the covered period? How many weeks do we divide their hours by? So how I would do when I say weekly is I calculate how many FTEs I had in any given week, and then I take that as the average of that as my number of FTEs. And you look at your FTEs on a week-by-week basis, and that's your average weekly FTE. So if I have 24 weeks, I calculate the FTEs for each of those 24 weeks, and I take the average of that. So that would that takes care of how I recommend doing that. Again, they haven't given a ton of color on this FTE calc, other than what they have there. What we said. Use your best judgment when it comes to all of this. What they want to know is what your average FTEs are over your covered period. That's what they're looking to calculate. Use your best judgment as it comes to all of that. My FTE came back to 60%. However, my business is down only 30%, meaning my FTE reduction is 40%, 10% more than my business is down. Would I be forgiven the full amount? A lot of questions there. If you are able to say that I am unable to return to the same level of business activity, and you can document it and show it, you can avail yourself to the safe harbor. If you are unable to do that, and you have an FTE reduction, that could impact the amount of forgiveness that you are getting. So keep that in mind. If completing Schedule A for Form 3508, we have a safe harbor of 1.0, can't we stop there and use 3508 easy instead, certifying that we had no wage reductions or reduced number of FTEs? Yes. Again, you can use, if you can certify the EZ, you can use the EZ. I just feel like if I just said everybody certify and use the EZ, the presentation would have been shorter and not as helpful for a lot of people. But yes, if you are going into those safe harbors, you can use the EZ versus the full 3508. if the lease is held by an LLC that the owner is not part of, but the parents are the owners of the LLC, is the full lease amount allowed? I don't know how they're necessarily defining that. I didn't dig into that. I can tell you that under tax law, parents are considered to be a related party. Under my interpretation, the conservative way, I would say that you should only take the mortgage interest in that case. You should treat your parents, your kids, and your spouse as all one person for these. It's a conservative approach that won't steer you wrong. Is a non-voting LLC owner who owns 12.5% considered an owner for the limitations on the cash comp? The limitation is for anybody that owns over 5% off of memory. I'd have to double check that, but I believe over 5% is the threshold that they are looking for. If we have a PC and we have 25 owners, less than 5% each, is their payroll limit 21 or 46K? Again, if it is less than 5%, I believe they do not count as an owner, and you will be eligible for the 46K. Is it required to fill in the FTE reduction Safe Harbor 2 section if you know you don't qualify? I would say no, I wouldn't. If you know you don't qualify, I probably wouldn't waste the time to fill it in. Could a bank tell you differently? Maybe, but I'm gonna let you know that my feeling is that you probably don't have to do that. Finally, okay, we had one employee who worked 2 hours a week as of February 15th because this work was on-site specific. She is not currently doing those 2 hours per week. Can we use the easy application if there's the only reduction in hours or wages? Technically speaking, no. Doesn't mean that de minimis there. Would I think about it? Maybe, but on you want a technical answer, the answer I have to give you is no, you can't use that application. All right, so if there's no other questions, again, thank you everybody for attending. It's been another great seminar. Hopefully we'll have a couple more of these in the future as we feel more necessary. And if you have any other questions, feel free to reach out via email.